Private companies are staying private longer, so the only way to participate in the explosive growth of trending startups is to invest pre-IPO. But pre-IPO investing is not one size fits all. In today's episode, we'll explore the various ways that accredited and non-accredited retail investors can invest in pre-IPO companies. In IPO Radar news, Elon's Neuralink is raising money, Figma files confidentially, and Discord's founder is stepping down to play more video games. Welcome to the Access IPOs podcast, where we explore opportunities to invest in the world's most innovative and disruptive pre-IPO companies. I'm Craig Stevens, founder of AccessIPOs.com. This episode is dedicated to helping ordinary investors find ways to invest in pre-IPO companies, understanding the various options out there depending on who you are. Why would you want to invest in pre-IPO companies? Well, private companies are staying private longer and delaying their IPO, so we just don't have the opportunity to invest in the public markets. A classic example is Tesla and SpaceX. So Tesla IPO'd in 2010 at a $1.6 billion valuation, and recently it's been valued as high as $1 trillion. SpaceX, on the other hand, has never IPO'd and is worth upwards of $350 to $400 billion right now. This is April 2025. If SpaceX had even IPO'd at a $10 billion valuation, investors could have participated in 35x gains, but we just haven't had that opportunity. And this trend has been growing throughout venture capital. It may go back to Uber. Uber waited a really long time to have their IPO, and Airbnb did the same. And by the time they IPO'd, all their explosive growth was already built into the price, and the venture capitalists and the employees and founders made all the money. And since then, just the stocks have not been all that strong. So we can go into why companies are staying private longer, but we'll save that for another episode. This episode is really dedicated to understanding the pre-IPO opportunities. Because if you want to invest in and profit from these growing companies in their fastest growing stages while they're pre-IPO, then you have to get in somehow before their IPO. And a lot of these companies just aren't IPOing, so it could be years until you can participate. And that's why I cover pre-IPO companies, because they are the next upcoming IPOs technically. It's just they're waiting longer and longer to IPO. And the companies that are IPOing maybe aren't all that exciting a lot of the times. Now, we had a pretty good pipeline in 2025 until the IPO freeze. That was a result of the tariff announcements, and hopefully 2025 will come back soon. In the meantime, we're going to focus a little bit today on how we can access these pre-IPO companies. So this episode, I'm going to kind of talk in two parallel lines, one for accredited investors and one for non-accredited investors. I think non-accredited investors get frustrated because of the limited opportunities to invest in a lot of different assets, but there are more opportunities nowadays to invest in pre-IPO companies that we didn't have, say, 3 or 4 years ago. So I'll outline a couple of those opportunities, and then we'll talk about how accredited investors can access companies and the risk-reward opportunity. And we'll primarily focus on US-based investors because that's where I'm based, and that's where it's easiest to invest. For people overseas, it is more challenging, but we won't be touching on that today. Accredited investor is a term that the SEC uses to distinguish more sophisticated investors, and accredited investors are allowed to invest in more opportunities. Most of you know what an accredited investor is. I'm just sharing my screen with the SEC website right now. The financial criteria is that you have a net worth of over $1 million, excluding primary residence, and that works for either an individual or a spouse and partner. The other financial criteria is income over $200,000 for an individual or $300,000 for a spouse with a partner. Most of us know if we're accredited or not. Essentially, if you're a millionaire or if you have a high income, you're accredited, and if not, you're not accredited. In the crowdfunding space and the VC space, that distinguishment opens up various opportunities for investors. So let's look at some ways to invest in pre-IPO companies. First, most people in America at least are non-accredited investors, and that doesn't mean they don't want to invest in great companies. They just don't qualify in the eyes of the SEC to invest. But there are some opportunities to invest for non-accredited investors. I talk about these a lot on my website. The first one is venture capital funds. And there are really only two of these that I know of that retail non-accredited investors can invest in. And they are the Fundrise Innovation Fund and the ARK Venture Fund, which is managed by Cathie Wood, who's a pretty famous ETF investor manager out there. So the Fundrise Fund has a $10 minimum. There's a lot of great companies in the fund that ordinary investors can own just by owning this fund. So Databricks, Anthropic, Canva, Vanta, Anduril is in there, Ramp, a lot of high-profile companies. Still owns Service Titan, which was an IPO in December of 2024. This is as of April 2025. So a nice selection of companies here that you can own by opening an account at Fundrise and investing. I'm an affiliate partner, so if you use one of my links, I'll get a commission. But I own this, and the access for non-accredited investors is really unparalleled, except for the ARK Venture Fund, which owns, I think, 30-some companies: SpaceX, XAI, Anthropic. I'm sharing my screen if you're listening on the podcast, but you go to ARK Invest website and you can see this. Grok, OpenAI. Both of these funds actually own OpenAI, Apptronic, Figure AI, some companies we've been talking about. Revolut is in there. So a lot of great companies in both of these venture capital funds that are really specifically targeted for non-accredited investors. Fundrise Fund is a $10 minimum. The ARK Venture Fund is a $500 minimum. You have to open an account with SoFi Invest to invest in that fund. That's really the only stipulations. You have to open separate accounts. These are not tradable securities. They are non-traded. And so you have to have accounts in either Fundrise or SoFi Invest to be able to access these funds. There isn't as much liquidity. And I'm not going to get into all the details and the fees and everything, but just know that these are out there, and do your research, of course, before you invest in either of these funds. The next option for non-accredited investors is equity crowdfunding. Equity crowdfunding has been around since about 2012 in the Jobs Act of 2012. And this is where startups can access capital from the crowd, from small investors who are non-accredited or accredited and can invest in these companies. And equity crowdfunding is earlier stage typically and higher risk because these are companies that are unproven. They're just trying to raise their initial funds. A lot of times they don't have a proven product, or their product is maybe invented and there's a nice deck or video online, but they're not really far along with their sales or anything. But this is a way to invest in pre-IPO companies. And actually some later stage or mid to late stage companies are using equity crowdfunding more. Some of our readers have invested in EnergyX or Boxable or Miso Robotics, Aptera, Motors. These are companies that have used the equity crowdfunding laws to raise money directly from either customers or just ordinary investors, but have not raised money necessarily from venture capital. Typically, venture capital wants to invest in the best companies out there and the companies with the most growth prospects, and those typically aren't the equity crowdfunded companies. You think of a company like Anyscale with Cursor. That's a company right now that VCs are dying to invest in. It's growing very fast. They're not raising money from equity crowdfunding. They're going straight to the VCs. The laws have been loosened so that retail investors can invest this way. I see it as a pretty high risk, low reward opportunity because a lot of these companies are just unproven. But that doesn't mean you can't make money in equity crowdfunding. And in just a few minutes here, I'll share a research platform where you can learn more about equity crowdfunding and the different investment platforms where you can access these deals. And then finally, on the non-accredited side is indirect investing. This is where corporations that are public have invested in private companies, and so you can own those companies to get indirect access to the equity of a private company. Now, this is a very low risk, low reward way to invest. If, for example, Google is investing in an AI startup, and Google's a $3 trillion company, and that AI startup goes from $1 billion to $100 billion in valuation, you're not really going to see that in the stock, but it's almost like a representative way to invest. If you want to access a company that you can't otherwise access, you may be able to do it through a public company that has a venture arm. And I'll talk about a few of those companies in a bit here. There are also some equity mutual funds that have some pre-IPO investments. And I'll talk about one or two where Fidelity or T. Rowe Price are really the two main ones. They make some investments and you can own that mutual fund to get some exposure to pre-IPO companies. And I'll give you one or two examples in the next slides. And then there's one other way that non-accredited investors can invest in pre-IPO companies, and it's through these new pre-IPO ETFs. I only put it here because people might say, oh, you're forgetting about this ETF or whatever. And I'm not going to mention the ETFs out there, but there are these traded ETFs that own stakes in private companies. And frankly, I just don't recommend them because you can't put a second-to-second trade on these values. And so these ETFs that are out there, I think there's a huge mismatch between the net asset value and the traded value. So I'm not going to talk about those anymore, but they are out there. I just don't recommend them. On the accredited investor side, venture capital funds, of course, you can still access these venture capital funds I talked about before, but then there's also more funds available in these pre-IPO platforms or secondary market platforms that we'll talk about here shortly. Will offer both individual investments in specific companies, or they'll offer multiple companies through a fund. They might be thematic, they might be just diversified pre-IPO funds. And so there's a lot of those out there, but accredited investors definitely have more options in that space. Another option is syndication or syndicated deals, SPVs. These are special purpose vehicles that venture capital firms and investment firms put these SPVs together and sort of syndicate deals, similar to real estate, how a real estate syndicator might go out and find a bunch of investors, put them all into an LLC, and then invest into a private opportunity. These are becoming a lot more popular these days because there's a few services now offering SPVs as a service. And so there are people just standing up these companies that are creating SPVs and making investments into private companies that they want to own. So I call this syndication or SPVs. And then there's some overlap between these platforms. These secondary platforms are putting these together as well. So there might be individual firms doing it. Some of the platforms are doing it. But SPVs in general, we're seeing a lot more of those versus directly investing into these companies. And that's the last option here is if you can get direct ownership shares of a company, either through a network or through a platform where you can attain shares directly in the company. That might be a little more challenging depending on what the company is and depending what the platform is and how much money you have to invest. So I recently got this Q1 2025 market update report from Caplight. Caplight's a data aggregator. This is from April 2025. And I saw this great chart about how SPVs have accounted for nearly 50% of volume each of the last 4 quarters. You can see a clear trend here where investors are getting access more to SPVs rather than direct shares. And that's just the way the market is going. This is one of the reasons why companies are staying private longer. You can bring in more individual investors, more institutional investors into an SPV and then put the SPV on the cap table versus an individual. And so you can get a lot more participation through SPVs. And there's some cap table restrictions or requirements or limitations that they can sidestep with these SPVs. And again, the topic for another day. All right, I'm sharing my screen now, and we're looking at this retail pre-IPO investing quadrant. And if you're listening as a podcast, I'll put a link in the description to this image. And it's a quadrant with 4 squares, and it has a curve from the bottom left to the top right. And on the bottom, it says ease of access, easy to difficult. And on the left, on the y-axis, it's risk reward, low to high. And I've sort of estimated where I place some of these types of investing in this risk reward and ease of access quadrant. And if you look at the bottom left, we have indirect investing. This is a low risk, low reward way to invest in pre-IPO companies. This is very easy to do, but you're just not going to get a lot of benefit out of it, even though you might get access to certain companies that you wouldn't get access to otherwise. As we move up the curve, we get to the non-accredited VC funds, and this is where I'm primarily invested. The Fundrise Innovation Fund, the ARK Venture Fund, these are, again, available to accredited or non-accredited investors. And if you're looking at the quadrant on the left side, we're typically talking about non-accredited investors, and on the right side, we're talking about accredited investors. Also in the high risk reward area, but not on the curve quite so much, is this equity crowdfunding. And I put it here as an outlier in this top left quadrant because equity crowdfunding is pretty easy to get into. You just have to sign up for one of these platforms and you can invest, and it's small dollar amounts, typically $500 to $1,000. But I think that the risk reward opportunity is more challenging here, and I would err toward high risk, low reward with equity crowdfunding because a lot of these companies are just unproven. We don't know much about the founders. They don't have revenue. They're really in the early stage, and early stage startup investing is harder anyways. You got to try to pick these winners really out of a massive haystack. So I've got equity crowdfunding up there, not quite on this traditional curve. As we move further up the curve, we get into the accredited VC funds, and this is where you can invest in a fund of startups, usually through one of these platforms, but there are some syndicators that put these together as well. And then we come to SPVs and direct shares, and I have SPVs before direct shares on this curve because it's just becoming easier to invest in SPVs versus direct shares, but you still need to be accredited. And then also these SPVs come with higher fees. If you're going to be investing through an SPV, there's going to be a management fee and a carry fee. So your fees are going to be a little higher with the SPVs, legal fees as well. versus direct shares. If you can get shares direct, you're still going to pay fees, but I think there's probably a little more fee action on the SPV. So this quadrant, if you can take a look, if you're listening to the podcast or I'm sharing it on YouTube, this is how I think about ease of access and risk reward. And I try to play in this high risk reward, but ease of access area with this non-accredited VC funds. And I have actually done a little bit of equity crowdfunding. I do have some holdings in this space. And even though I'm accredited myself, I'm still playing in this non-accredited investor space with just accessing the VC funds because they're the easiest to access. You get a diversified pool of investments instead of just picking one or two, and it's very easy to invest. So looking a little more closely at the non-accredited investment options, where can you actually do this? Where can you actually access these investments? And that's what I want to show you here is like, if you want to actually go do this right now or consider an investment, where would you go to find these deals? We already talked about the Fundrise Innovation Fund. There's a $10 minimum, and the ARK Venture Fund, and I showed you those websites. Equity crowdfunding, there are several of these platforms. The first one I'm going to recommend is actually not an investing platform. It's a research platform that's sort of a data aggregator for all these other platforms that we're going to talk about, and it's called Kingscrowd. Kingscrowd is a place to find, research, and track startup investments. And when they say startup investments, they're really talking about equity crowdfunding. And so you can kind of see down the bottom, there's a couple different platforms that they highlight. But this website, Kingscrowd, you can track your investments here. You can do research on companies. But it's one of these places where you can do a lot of research and learning before you get into actually investing and choosing the platform you want to invest on. One of the top equity crowdfunding platforms, and I have an account here, it's called WeFunder. WeFunder is a place where startups can raise capital and investors can invest in these companies. And on the right, I'm sharing my screen. You can see the website. There's some pretty big names that have come out of WeFunder. They have a lot of investors. They've raised a lot of money, almost $1 billion, it looks like. They've funded several different companies, a lot of very interesting companies to invest in. Actually, this is one I've invested in here, Arrived Homes. I'm an investor on that platform, and I'm an investor in the equity of the company itself. So WeFunder is a very popular place to do this. Another one is Start Engine, and this has been around for quite a long time. Kevin O'Leary is a spokesperson, probably an owner of the company. This company bought Seed Invest, which was another one that was popular in the early days. Lots of investing opportunities here in younger companies. They're also getting into pre-IPO late stage type of investing, similar to some of the other companies we're going to talk about. But you can see OpenAI here, Apptronic. So they're getting into a lot of different types of investments, but they started as a crowdfunding site and they're still primarily crowdfunding, but ordinary investors can invest here. Dealmaker is another one where young companies can raise money and investors can participate. It says here they've raised $2 billion and 900 and some offerings. That's a lot. Another one is Republic. This is a place where you can invest in pre-IPO startups in the equity crowdfunding space. So if you're interested in this kind of investing, I would start with researching through a Kingscrowd or some other aggregator if you know about them, but start to compare and see what's out there. And then looking at each individual deal, they each tell their own story and they have their own decks that you can review. I would caution, though, that some of these companies are very early stage and they might tell a really good story, but don't have any financials to share. So if you're going to invest in equity crowdfunding, keep your investments small and diversify. I wouldn't put all your eggs in one basket, but it is a way that non-accredited investors can participate in this economy. Then finally, indirect investing. We talked about this. There's corporate venture arms that are pretty active. Google is one of them, NVIDIA, Salesforce. I've seen Nucor, Honeywell has an investment in some companies. Microsoft, Chevron, I don't have on here. Chevron is an oil company. If you go to my website and search for a company name, sometimes you can find investments by these corporations. So I type in Chevron into my search. You can see they've invested in Zap Energy and TAE Energy. These are both fusion startups. Chevron has made an investment. If you put Salesforce in here, Salesforce is very active with their venture capital arm, DataRobot, Airtable, Stripe, Hugging Face, Databricks, Gusto, lots of different private companies. And so Salesforce could be an opportunity just to invest in a bunch of companies, almost like a diversified fund. Again, you're not going to get a big return on your investment, but we're all about finding access and finding other ways to invest if we can't invest directly, especially for non-accredited investors. Mutual funds have some investments. The Fidelity Contra Fund is one that I know has invested in SpaceX, for example. So I have owned Contra Fund for more than 20 years. In fact, Fidelity invested in SpaceX back in 2015. And the Contra Fund has really benefited from that. T. Rowe Price makes a lot of investments pre-IPO, and you can search T. Rowe Price into my website search and see all the different companies that they've invested in. They're not as transparent about their actual investments in their mutual funds. There's one called, I think, New Horizons, T. Rowe Price New Horizons, something like that apparently has some investments in pre-IPO companies. But again, it's not very transparent, so it's kind of hard to know specifically what they're investing in, whereas the Fidelity, you can see at least SpaceX is there and a few others. Accredited investors, again, we have this venture capital funds. They're diversified and they're often thematic. So you'd have like a defense venture capital fund with diversified holdings all in the defense space. AI is another one, of course. Space, you can invest in SpaceX and Axiom Space and Relativity Space through one fund, etc. There's all kinds of thematic investing. And you can buy these on some of the secondary platforms, and you might have some syndicators doing it. But as far as secondary platforms go, Hive is one I talk about a lot. Hive has the Hive 50 index. They track a lot of pre-IPO stocks here. There's a marketplace where owners of equity put up their shares and name a price, and you can name your price on the bid side. A very active marketplace, one of the top ones. Another one of the top ones is Equity Zen, which has been around probably the longest, or it's one of the oldest ones, along with Forge Global. And again, these are places where you can transact. Sometimes they have funds, sometimes they have individual shares available, sometimes they have SPVs, just like we talked about. They're serving as these syndicators. Another one is NASDAQ Private Market. This is a place where you can list your shares if you own them, or you can look for a buyer if you're trying to sell them, or if you're a buyer trying to find shares. Then there's Equity B, and this one's more tailored to employees that have stock options that maybe can't raise the cash to exercise the options. And so Equity B opens up some opportunities for investors to come in. When a company has an exit and the employee has options and they're ready to liquidate, then that's when the investors who have participated on Equity B get their share. WeFunder and Start Engine are also getting into this space of pre-IPO deals where accredited investors can access deals. WeFunder is not as obvious that they're doing this, whereas Start Engine is a little more obvious. They're promoting these a bit more. But if you sign up for accounts with any of these companies, you'll start getting email alerts on what's available. Again, these are for accredited investors. The last one I'll mention is Link2. Link2 was actually a pretty good platform in terms of access. They have a lot of shares available in different companies. They actually buy big lots of shares and then resell them to investors with very low minimums, so making it very accessible. They've had some problems recently. Apparently, some investors their money is tied up and they're not transacting anymore. So if you have an account with them, or if you're thinking about opening an account with them at this stage, April 2025, we're not sure where that one's going. It was convenient. Their valuations were a little high on some of their deals. So you do have to be careful on this one because they're padding the deals a lot. And some of the other ones do this too. It's not just Link2. You always have to watch the valuation of these companies that you're investing in. Ideally, you have a platform where you can invest and a platform where you can get data to know, hey, where are the shares trading for this company? What's the share price of this company before you participate in a deal? So you want to shop around if you can have multiple accounts to see where these prices are coming in. I see prices all over the place for various companies when they're either raising money or they're putting together an SPV on one of these platforms. Several $1 billion can separate one price from another. So you got to do your research anytime you're investing on any of these platforms. Just because you're on the platform or they have shares doesn't mean the price is fair. So try to find yourself a platform where you can get data to compare against the price that is available to you at that time. So last, there's syndicators. These are typically network-based. So somebody with a lot of money or a lot of contacts opens a company or a fund. They use a SPV as a service company to put together funds for them, and they sell pieces of the SPV, the legal entity that will then invest into companies. They syndicate these with their family and friends first, and then they may expand on the internet and finding other people to invest. So it starts with family and friends. These syndicators are sort of starting to pop up online, and they're almost looking like platforms. You might think, this is a pre-IPO platform, but actually it's just somebody who's putting together a bunch of investors and then investing into deals. That's not necessarily a bad thing. You just have to know who you're dealing with. If someone's putting together deals in real estate, you want to invest with the guy, right? You want to know who's putting the best deals together, invest with that person. And so if you're investing with a syndicator, you want to know their background. And that's why this is often network-based. Sometimes it takes an introduction to be able to invest, or you come in through a family or friend, or maybe through a financial advisor who works with these pre-IPO syndicators to offer that service to clients. So again, lots of options. Trust your syndicator if you're going to invest this way. So this was a high-level overview of how to invest in pre-IPO companies, whether you're accredited or non-accredited. For non-accredited, your options are limited. We've given you a couple options here where these funds are available to non-accredited investors. There's only 2 that I know of. If you know of any others, let me know. There's also equity crowdfunding, but these aren't the companies of our time that we really want to invest in. If you think back to when ChatGPT came out at the end of 2022, everyone was thinking like, how do I invest in this company? And when you did a little bit of research to learn how, you learned it wasn't possible. With these venture capital funds, it has become possible because they've owned shares. And even in the private markets, a high-profile company like that is hard to get access to. But when you're non-accredited, it's much harder to do. And when you're overseas in another country, if you're not U.S.-based, it's going to be even harder, unfortunately. Accredited investors do have a lot of options, but you need to research the platform that you want to choose to invest on. I would find the one that has the most deals, or the most deals that are attractive to you, or the ones that offer the funds that you want to invest in, and kind of just stick with that one. You can also sign up for accounts with all of them, and that's what I do. So I see all the deal flow that's happening. And a lot of times they have similar investment opportunities on all the different platforms. If you're going to syndicate through an individual, ideally it'd be someone in your network that you would trust to give them $10,000, $100,000. But typically you're going to be looking at higher investment minimums, $25,000 often, where these platforms will get you in sometimes at $10,000 to $15,000, very rarely $5,000 or less on these platforms. It's usually going to be $10,000 above, but the more money you have to invest, the more opportunities are going to be available. $100,000 is a pretty big stretch for a lot of my listeners, a lot of my readers. Even 50, get down to 10, 5 to 10,000. I think that's where a lot of people, that's their sweet spot, where they'd want to make a lot of investments at that $5 to $10,000 level. But these platforms are really designed for bigger investments than that. So do your research before you open an account with any of these companies. Do some due diligence on anybody you're looking to syndicate through. And remember, this is investing. If you want the reward, which could be multiple X returns on your VC investment, you've got to take some risk, but try to mitigate those risks by validating who you're investing with and diversifying as much as you can. Let's move on to IPO Radar news. This is where every week I talk about some of the news that's happening in the pre-IPO and upcoming IPO space. And unfortunately, things are very slow. It's been a very slow few weeks here since the April 2nd tariff announcement. We have this IPO freeze that started after that. And that was my last episode was focused on the IPO freeze. And there's really been no signs of recovery or thawing from that freeze. We're still in this to be determined phase. Too much volatility for Klarna and StubHub to come out of their shell. So this week's news is really focused on some of the pre-IPO news that came out. None of them are earth-shattering, but still interesting nonetheless. The first one is Neuralink. Musk's Neuralink is eyeing a $8.5 billion valuation in a new funding round. They're looking to raise about $500 million at a pre-money valuation of $8.5 billion. This is according to a Bloomberg report by Gillian Tan and Ed Ludlow. Neuralink is this computer brain interface company. They've invented a machine, a robot that will implant a chip in your brain, and it can connect to a computer, and it's doing pretty cool stuff. They've had a couple people try this. There's a paralyzed man, I forget his name, he's on X, and they've implanted this chip, and he can control a computer with his brain just by thinking about it and play video games and stuff. And it's really life-changing for this guy, and the implications of this technology are life-changing, especially in the medical field. There's lots of different applications of it. We all know Elon, though. He's got bigger plans than that, and I think he sees in the future that this would be a way to integrate AI into our brains and become these super-powered machines like you'd read in a sci-fi movie. I'm not sure the timeline of that. I can't guess. I think the medical implications are going to be more exciting, at least in our lifetimes. The last funding round was a Series D. It says on my website, April 2024 last year, was valuated at a $3.5 billion valuation. They raised more than $300 million. And I think we're seeing a typical Elon premium on this, with a company with a high risk, high reward opportunity. And I think we'll start seeing shares of this company pop up more frequently on the pre-IPO platforms. I have seen them several times over the last year or two. So don't be surprised if you start seeing opportunities to invest in Neuralink. Where this goes, nobody knows. I'm not going to take a guess, but very exciting technology. There's another one in the space that I've written about called Synchron. Synchron is also a brain-computer interface company that uses a slightly different technique. They don't implant in the brain. I think they slide something up a vein into your brain, and it's got tentacles that can reach into the neural nodes or whatever is going on in the brain. So Synchron is another one to watch, but Neuralink gets a lot of the press because, of course, it's an Elon company. But as far as I understand, Synchron is moving along pretty well also. Next up on our radar is Figma. Figma has filed confidentially with the SEC. So Figma is a design collaboration SaaS, as I understand it. It says here it's a software platform for collaborative design and application development. Figma was an acquisition target by Adobe, and they had to walk away from that deal. The company inked a deal to be acquired by Adobe in September 2022, but the companies decided to end their merger in December 2023 due to regulatory roadblocks. Regulators perceive the deal as anti-competitive due to similarities to the Adobe XD product. So now that Figma is not destined to be acquired, it's filed confidentially for an IPO. That was supposed to be about a $20 billion deal. We got some whispers last month in March about Figma being in talks to explore an IPO. That was a New York Times article. And now here we are, about a month later, they've actually submitted the paperwork. Now, this kind of surprised me a little bit because remember, Plaid was another company on our radar, and Plaid was supposed to be acquired by Visa, and they ended up having to walk away from that deal due to anti-competitive measures. And it's a similar situation here. It turns out that Figma has gotten their act together. They were maybe getting close to being IPO ready before they thought about that acquisition. The acquisition fell through, and here we are. Figma is ready to, or at least preparing to move forward with their IPO. Once this confidential filing goes into the SEC, they need to review the document, and there'll be some back and forth where they maybe make some suggestions to improve it for more disclosures for investors. Typically, the earliest we'd see an IPO after a confidential filing would be about 3 months, maybe 4 months, where we'd get an updated public version of the S1. Sometimes these companies submit confidentially and we don't hear back for another year or so. And that's actually pretty common, especially when there's volatility like there is now. So looks like Figma is not too worried about the current volatility. They expect things to maybe settle out. And this is a SaaS, so they're not trying to source materials from China to run their business. They're just making software, putting it on the internet and letting people use it. So this model shouldn't be impacted too much by tariffs. So it looks like they are going to be moving forward, hopefully this year. So I've updated my upcoming IPOs page to reflect Figma. I think it's in the top 10 now. And a $20 billion valuation. That's a pretty nice size IPO that we could hopefully get some access for retail investors through one of the brokers that does that. In our last story for the day, CEO, founder of Discord, Jason Citron, is stepping down from the CEO job. They've hired a guy named Humam Sakhnini as the new CEO, and he was apparently the former CEO of Activision Blizzard. So I reported a few weeks ago that Discord is on the path to an IPO. And if you think back to an interview with Jason Citron on the Harry Stebbins podcast a few months ago, I think it was in the fall, I listened to this one. Harry asked Citron if he was excited by the prospect of being a public CEO, and he very clearly said, no, that doesn't excite me too much. I'll do it, but he's really more interested in building the company and building products that people want. Now here we have Jason just stepping down entirely from the CEO role. He's bringing in someone who has been the CEO of a public company, so he knows how to deal with those quarterly investor calls and expectations of the bankers. It says here in this article, there was an exclusive interview with Jason on the VentureBeat website. It says here, they asked whether Discord was still headed for an IPO. They're supposedly on the path toward an IPO in 2025. But Jason says, we have no specific plans, but as you can imagine, hiring someone like Humam is a step in that direction. They're working with Goldman Sachs, JP Morgan on a planned IPO. They've now hired a CEO who's experienced in running a public company, and Jason is stepping back. So as long as the IPO window starts to thaw, as long as the tariff situation gets figured out, and again, Discord is not one of these companies that's reliant upon China or other countries for supplying goods. This is another SaaS or social media SaaS. As long as things start to settle out and the VIX, the volatility index, starts to flatten out a little bit, I think we'll see this Discord IPO by the end of the year. My favorite part of this interview, this GamesBeat, this VentureBeat reporter asked Jason, "What are you going to do right away, Jason?" He says, "I need to finish Final Fantasy VII Rebirth. I have a backlog. I want to play Blueprints, and I haven't even played Baldur's Gate 3, believe it or not. These are amazing 100-hour titles. It's hard to do that with young kids and running a company, so I'll spend some time and chip away at the backlog." So Jason Citron started this company, Discord, as a place where video gamers could connect with each other in a social manner online. And he's now stepping back from his role as CEO to be almost a full-time gamer. Now, he's not fully stepping away. He's going to continue to be a consultant and on the board of directors. But pretty cool to see this guy taking a break, getting away from the future of this company, which is going to be probably public, which is going to benefit all of us, right? This is a way for us to invest in a great company, a social media company. We don't get a lot of those going public. Whereas Jason can step away and do his thing. We're going to get a chance, hopefully, in this year to participate in the IPO and then invest in Discord for the long term. So good for him going to play these games. And actually that Baldur's Gate, I've heard that's cool. I might be trying that one myself. I'm kind of a part-time video gamer. I play some Zelda on the Nintendo, but I want to get a little more serious with these role-playing games. So Baldur's Gate 3 could be one for me. That's all for this week's show. If you like what you're seeing here, there's 3 ways you can support the Access IPOs podcast. The first is to just subscribe to the Access IPOs newsletter. There's a link in the description to do that, or you can go to accessipos.com, and there's a free download, which is pretty cool. It's called Startup to Public Company, the IPO process. So that's the first way you can stay connected. That's a weekly newsletter now, comes out on Sundays. New podcast comes out on Saturdays. Second way you can support the show is to follow us wherever you subscribe to podcasts or follow podcasts or listen. I'm on Spotify and YouTube primarily, but you can get me on Apple or any of the other podcast networks. Just like us wherever you consume your podcasts. And if you're ready to write a 5-star review, I'd love to see a few of those out there. Haven't gotten any yet. If you don't think it's a 5-star review, let me know. Give me your feedback on how I can make the show better. Those reviews also help to attract more listeners. When listeners see those reviews, they're more likely to follow the show. And the last way that you can support the show is to check out links in the description. There are affiliate links from my partners. I talked about the Fundrise Innovation Fund today. I'm an affiliate partner there. There's a link in the description. If you click that and you open an account, I'll get a commission. No additional cost to you. That's just kind of how online businesses work. I thank you for supporting independent publishing that way. There's also a link to my membership site. It's on Patreon. It's called the Access Club. And this is where I share all the news that I gather for this podcast and for the website, which actually covers almost 200 companies. I share weekly news updates. I share timely news updates. And then I share deal alerts. So when I see hot deals that are available on some of these platforms, I tell people what's happening and kind of give you alerts to let you know, like, hey, this is a company that's hard to get access to. Here's the opportunity. I also give a weekly summary of all the action I've seen in the pre-IPO marketplaces. So if you want timely news, timely alerts for deals, or if you just want to support the show, go to the Access IPOs website and you'll see a link to the Access Club. Click that, sign up on Patreon. It's a paid membership, but it's only $5 to join at the lowest level. All the money that's coming in through Patreon is going back into the podcast and supporting the show and growing the show, growing the audience. It's also a place to connect with like-minded investors, and it's the best place to connect with me. That's all for the show. Thanks for watching, thanks for listening, and I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.